What if I told you there's a way to detect when a breakout is more likely to fail? Or better yet, what if there was a tool that could help you spot real continuation before it even happens? What if I told you you could see where buyers are getting absorbed, where sellers are running out of fuel, and where the market is literally showing its hand? And what if I told you you can have two green candles, the exact same size, but one has way more buying volume than the other? That's where footprint charts come in. And if you've been trading with just price and candles, this might be the last piece of the puzzle you've been searching for. When I first got into trading, I'll be honest, I had no clue what I was actually looking at. I was throwing indicators on charts, watching candlesticks move, and hoping something would click. Most of the time, I was just reacting, trying to convince myself I was trading with a plan when really, I was just guessing. I remember this one setup looked clean, perfect breakout. I jumped in, 2 minutes later, I'm stopped out, and the market just rips in the opposite direction. I didn't get it. I felt lost, like the market was always one step ahead. But once I learned to read footprint charts and actually see what was happening inside those candles, it finally made sense. I stopped reacting and started reading. Footprint charts show you real-time executed volume at each price level. They don't just show where price moved, they show why it moved. You can literally see who's winning the fight between buyers and sellers. So there are going to be 3 different types of candlesticks we're going to go over. We're going to start with the bid and ask, and then we're going to go over the delta footprint, and then we're going to go over the volume footprint. I use the bid ask footprint. I believe it's the most useful information when reading the market in real time, especially when you're trading directionally. And as we get into this, I think that'll make a little bit more sense. We're going to start with this candle as an example right here. You're going to see the numbers on the left and right side. We have 2 columns, one on the left, one on the right. All of the numbers on the left column, these are going to be our bids. These are people hitting the bid. All of these orders in the right column, these are going to be all of the asks or the offers. But one thing to note is that these are all aggressive orders. So when somebody's hitting the bid, these are aggressive sellers on the left side. When somebody is hitting the offer, these are aggressive buyers on the right side. Whenever traders are making decisions at price levels, we'll be able to see the orders coming in and out of the market. Somebody's asked before, well, Errol, what about the spoofing orders? What about, is this reliable? What if people are putting orders in, then whenever the market comes back to those orders, what if they pull them? That's what spoofing is. The thing about footprint charts is it shows only aggressive orders in the market. Aggressive orders are market orders. So these are all orders that are executed at market, because market orders are called aggressive orders because of how aggressive it is, right? With the market order, you're looking to get filled at the best or the next best available price. That's why we call them aggressive orders, right? We have market orders and we have limit orders. Limit orders are going to be our passive orders. These are going to be orders that are waiting to get filled. Whenever the market gets up to that limit order, you will then be filled, right? It takes a lot more of a passive approach with the limit orders. That's why we call them passive orders. Whenever we're reading a footprint order flow chart, keep in mind these are all aggressive orders. Now, we broke down that the left side is going to be all aggressive sellers, the right side is going to be aggressive buyers. The most common mistake traders use when first reading a bid-ask spread is they read it left to right, right? They'll read 17 sellers to 97 buyers, 26 sellers to 58 buyers, when we should really be reading this diagonally. Okay, so this is 17 sellers to 58 buyers. This is 26 sellers to 67 buyers. This is 13 sellers to 43 buyers. You get the picture. Now, once I explain these imbalances, it'll make a lot more sense. So you might already be wondering, yo, Errol, what are these yellow boxes that are highlighted on the bid-ask spread? Like, that might be important. Is that important information? Why is it highlighted? In the term, it's called an imbalance, right? So this is going to be an imbalance between buyers and sellers. So whenever one side of the market is heavily dominating the other side at a specific price level, we'll see these imbalances pop up on the bid or the offer, depending on which side of the market is currently dominating. In this case, like we said, the right side are aggressive buyers. The buyers are dominating because we have some stacked imbalances at specific price levels. And like we talked about before, when we read a bid-ask footprint, we read this diagonally. So you can see here, we have 7 sellers to 47 buyers, right? We have about a 4-to-1 imbalance. We have about 4 times the amount of sellers at that specific price level. Here, we have another imbalance, right? We have about a 5 or a 6-to-1 imbalance of buyers versus sellers, right? Buyers are being a little bit more aggressive than sellers. We have an imbalance at these 2 price levels. Now, whenever you're using the imbalance, you can go into your settings. I have mine set to show me imbalances whenever there's at least a 6-to-1 ratio, right? So whenever there's at least 6 times the amount of aggressive buyers than sellers, or 6 times the amount of aggressive sellers than buyers at a specific price level, then it'll highlight and show me that there's an imbalance occurring at that exact price level. So I have mine set to 650%. You can choose what's going to be best for you depending on your trading style and depend on the sensitivity levels that you like to see in the market in terms of momentum and confirmation and whatnot. I believe the default setting is like 250 or 350, and I just wanted to clean it up. I wanted the market to only show me the most important, most significant imbalances in the market, because I don't want to be seeing imbalances on the bid and the offer every 5 minutes. You know what I'm saying? I just want to see the most significant ones. That's why I upped mine to about 650. Now that we know what a bid-ask footprint is, this is a perfect example of using this in live time. Let's say you're looking to buy a breakout, or let's say you were looking to short a breakout. Maybe you're looking to get short off of a liquidity sweep, or maybe you are looking to buy the breakout. Maybe you believe short sellers are going to get squeezed at this price level. Here's a breakout level, right? And you can already see we have a lot of imbalances on the ask. Right, so we already know right here, buyers heavily dominated this breakout level. And this is the confluence that I'm letting you know you can use into your trading to build that confidence and build that conviction. You can use it as a massive confluence, because for whatever reason, if you were looking to get long in this scenario, right, and you see stacked imbalances forming on the offer like this, multiple like that, right? In this case, we have about 5 stacked on top of each other. We have 6 in the picture at that breakout level. That would give you a lot more confidence and conviction to be able to buy and hold that breakout. On top of that, we do have the imbalances, but we also had no sellers. We had no aggressive sellers at that breakout level. Whenever we're trading in real time and we're looking to buy breakouts, or we're looking to get long for whatever reason, maybe you're trading off a fair value gap. You want to get long off of a fair value gap. What else have I heard of? A CISD, order blocks, whatever those terms are. If you're an ICT trader even, whatever you're trading off of, you can use this as a confluence. Whatever reason you're looking to get long, maybe you trade inverse fair value gaps and you get a bunch of stacked imbalances on the offer. That's going to give you a lot more confidence and conviction to actually enter that trade, right? You're not going to hesitate as much as you would have, especially when that's your trade thesis already, right? You're not buying this because we have imbalances forming on the ask. You're buying this because we have imbalances forming on the ask, and you already had a trade thesis built around those price levels, right? So it's used as a confluence. It's used as a form of confirmation to see how the orders are actually lining up in the market, so that we're not deceived by the candlesticks themselves, because we can't see all of this information with the regular candlestick like we've already discussed. So these are footprints. Before we look into the other different types of footprints, let's talk a little bit about how you can even manage your risk or change your bias when looking for an entry. Because let's say you were looking to get short, right, off of this liquidity sweep or breakout level. If you're seeing stacked imbalances on the offer, why would you be looking to get short? You know what I'm saying? Even if you're looking for that to pull back, if that's the information that the market's giving you right now, why would you be looking to get short right now, right? I can understand maybe if somehow this level fails, right, after we got stacked imbalances on the offer, because that would let me now know breakout buyers are now underwater. But from right here, right, just from this point on, like, there's no reason for us to be getting short, right? Delta's positive. We actually even see a little bit of absorption going on in this previous candle, which we can get into in other videos moving forward. But there's no indication, or there's no signs of bearish order flow at this moment. So if there's no signs of bearish order flow, why would we be looking to get short? Now, that's going to be your regular footprint chart. Let's change it to Delta. This is another popular one. There's many different settings that you can get your footprint charts on, and you can make them look completely different from mine. But another popular footprint chart setting is going to be Delta. Delta is going to be the difference between aggressive buying and selling within a candlestick or at a specific price level. There's a couple different ways to be able to read Delta. I'll explain those two right now. So again, like we know, Delta is going to be the difference between aggressive buying and selling. So if we have 500 buyers in this candlestick and we have 600 sellers, that's going to leave us with a negative 100 delta. You see the point that I'm making? It's going to be the difference of aggressive buying and selling. It doesn't mean there weren't any aggressive buyers. It just means in this point, there were more aggressive sellers. So the aggressive sellers outweighed the buyers, right? And the way that we can view that is on a footprint bar statistics. So over here at the bottom, you can see this row is going to indicate deltas for each candlestick. So most of the time, whenever we have a green candle, we're going to have a positive delta 9 times out of 10. I know this example right here, we have a green candle with negative delta. That's a sign of absorption. We're not going to talk about that in this video, but each candlestick is going to have its own delta. This has a delta of positive 149. That lets us know this candlestick had more aggressive buying than aggressive selling. You can see in the next candlestick over, Delta got a lot more aggressive. Now, we changed the actual footprint chart sticks to Delta. So what does that mean? This is gonna let us know the delta at each specific price level. Okay, so here we can see right at this breakout level, we have a positive delta of 28. Now we have a positive delta of 47. Again, it doesn't mean there wasn't any aggressive selling at these levels. It just means that at that very specific price level, there was that many more aggressive buy orders than sell orders. This one's pretty popular. I personally don't like using the delta footprint chart just because I can use the bid ask footprint charts, and I think that gives me a lot of information, and I can still get that delta information by using the footprint bar statistics. So I can get the same information. I don't think it's as useful using the delta, just my opinion and the way that I trade. But the next one is going to be volume. I never use this one. I don't think this one's even as popular, but this is going to be volume. It's going to show the volume at each price level. So we can see at these price levels, we had a volume of 82, volume of 91, volume of 138. Again, this is giving us a lot more information that we otherwise wouldn't have with the regular candlestick, but I would still be on the fence that the bid ask is going to be the most useful footprint charts to be able to get information that you couldn't on a regular candlestick.